Welcome to CBRE Fast 5. I'm currently Iacono, and tonight I am covering part 2 of the winners and losers of the last 12 months in the top retail segments. If you missed last week's episode, I covered arts and crafts, auto parts, convenience, deep discounters, and drugstores. If any of those segments are of interest to you, be sure to go back and watch. This week, I'll be focusing on gyms, home improvement, mass merchandisers, restaurants, and sporting goods. Let's go. I'm starting with a doozy this week, the fitness sector. It's estimated that about 25% of all gym facilities have permanently closed as of the end of 2020. Town sports and 24-hour fitness were two of the big casualties in the highly competitive mid-price market. LA Fitness is an interesting story. They got a $300 million loan, which gave them some breathing room. I've heard rumors of some expansion plans. We'll see. Planet Fitness, the only publicly traded company in the sector, reported year-to-date sales declines of 45%. Huge. However, they are still one of the stronger credits in the space and may be positioned to benefit from some of the smaller chains folding. Planet Fitness reported already that club usage is now 75% of pre-COVID levels, so 2021 could be positive overall for them. Moving on, in sharp contrast, I'm now going to cover the home improvement sector, which has been absolutely on fire this past year. Home Depot and Lowe's both reported impressive year-to-date sales growth of 18.2% and 23.5% respectively. Both have a fantastic omni-channel presence and were able to capture consumers' almost fervent focus on home improvement during the pandemic shutdowns. The economic benefits did flow through to the smaller retailers too, such as Ace and True Value. Sherwin-Williams also benefited. They added 31 new stores last year and plan to continue their growth into 2021. Tractor Supply, yet another example of the boon that the sector has seen. They have an impressive expansion planned and 25.7% year-to-date sales growth with 80 new locations in the works. If you are looking for retail jubilation, the home improvement sector is your answer. Another big winner was the mass merchandise category. Demand for essentials has been in high gear since the pandemic with consumer panic buying, etc. But in addition to that, the major players pivoted quickly and enhanced their digital platforms and their buy online and pick up in store capability. So that helped as well. BJ's had year-to-date sales growth of 18.2% and reported the growth in their membership numbers. Target had year-to-date sales growth of 19.2% and is looking to add roughly 30 small format stores in 2021. Walmart saw their online sales grow 200% in Q3 of 2020, and they continue to focus on their digital platform instead of store expansion in the US. It's worth noting right now, though, that e-commerce still is only 10% of Walmart's overall store sales. So they have a long way to go. Moving on, in the restaurant category, we have a tale of two markets. Full-service restaurants were hit hard, of course, with a mandated closure and capacity limitations that are still in effect in many places. Many independent restaurants and weaker chains have already permanently closed, which, on the bright side, could open up interesting real estate options for the strongest operators, such as Chipotle, which saw year-to-date sales growth of 5.6%, and they already opened 140 new stores in 2020. About half the openings included their new drive-through Chipotle model, which integrates nicely with their digital sales platform. I think we'll see even more growth for the chain in 2021. Jack in the Box is another winner, reporting 12.2% growth in the fourth quarter alone, their best performance in over 25 years. Starbucks is a big tenant that I follow closely. They're a question mark moving into 2021. Year-to-date sales declined 11%, but the company is undergoing a store optimization plan, and the closures could account for some of that difference. They now plan to close up to 500 stores in the US and 300 in Canada by the end of 2021. But they also plan to open 850 new stores in North America. So it's basically a wash, and it'll be interesting to see once they finish this reorganization where Starbucks falls. The losers in the category are no big surprises. Dennys with sales declines over 50%, Red Robin sales decreased 34%, Steak and Shake down 43%. I wouldn't be surprised if we see bankruptcy filings or restructuring from these brands. The last segment I'll touch on tonight, because I know we've been data heavy, is the sporting goods sector. Strong demand in most outdoor and sporting good categories provided strong sales and earning trends for the segment overall. The major players continue to expand and experiment with new store formats and more online presence. Dick's Sporting Goods saw year-to-date sales growth of 5.2% despite recently pulling out of the firearms category, which did well this year overall. DSG seems to be the best position to gain market share through their online channels, which currently represent about 21% of their total sales. Hibbett Sports saw sales growth of 19.7%. They opened 30 new stores last year. Sportsman Warehouse saw sales growth of 61%, but has a very heavy exposure to the hunting category, which could see a sharp pullback post-pandemic. However, on this particular store, Bass Pro Shops has agreed to acquire Sportsman's Warehouse, so this could provide the diversity that the brand needs overall, so they might be very well positioned. Academy Sports saw year-to-date sales growth of 18.3%, which allowed them to launch a successful IPO, which we covered a few months ago. Now Academy, now that they're on the other side of their IPO, needs to focus on differentiating themselves from the competitors like Dick's Sporting Goods and Amazon so that they too can capture more online sales. Camping World, very niche. They saw a significant boost from surging RV sales. The question now is, how long can the good times roll in that segment? Or is the market saturated with RV? Will be interesting to see. We covered a lot tonight. If you're curious how the current outlook or any of these tenant overviews affect the value of your particular property, feel free to give me a call and I'm happy to walk you through the insights in more detail. That was CBRE Fast 5. I'm Carly Iacono. I look forward to seeing you again soon.